So get this, Qualcomm just dropped a record-breaking quarter, absolutely smashing expectations. But at the very same time, the AI gold rush, the one making companies like NVIDIA an insane amount of money, is creating a huge, unexpected problem that could totally derail Qualcomm's main business. So what's the real story here? Is this company a coiled spring ready to launch, or is it a classic value trap? Let's break it down.
Yeah, it sounds kind of crazy, right? This is the central puzzle we've got to figure out. Qualcomm is firing on all cylinders at the absolute top of its game. But the tech that's driving the entire market forward, AI, is creating a supply chain nightmare that hits them right where it hurts, their biggest moneymaker. It's a fascinating, high-stakes situation.
All right, first things first, let's do a quick refresher on who we're even talking about. Because if you have a high-end Android phone, odds are you've got a piece of Qualcomm tech right there in your pocket.
These guys are the undisputed champs when it comes to designing the brains for premium smartphones, what they call a system on a chip. You can think of it as basically an entire computer squished down onto one tiny sliver of silicon. They're also the leaders in 5G modem tech, which, by the way, is why even Apple still has to pay them. But the real story, the one we're watching, is their big push into new areas: cars, PCs, and the whole Internet of Things. And we're not talking about a small company here. With a market cap well over $130 billion, this is a giant at a really critical crossroads.
Okay, so the reason we're talking about this right now is because of what just happened. Qualcomm dropped its latest earnings report, and man, the numbers were big. $12.3 billion in one quarter. That's a record for them. I mean, by any measure, that's a fantastic result. It shows demand is super strong. But then came the warning. Right in the middle of all the good news, the CEO comes out and says this, and you have to ask, why are there memory constraints? Well, it's fascinating. You see, all these new AI data centers are so hungry for super fast, high bandwidth memory, or HBM, that the memory makers are shifting all their production to feed them. This leaves less of the regular memory used in smartphones. So, the AI boom is literally eating the smartphone's lunch, creating a huge shortage for Qualcomm's most important market.
So here's the bottom line. We have a company posting the best numbers in its history. At the same time, it's telling us that the road ahead is getting bumpy, all because of a problem created by the biggest tech trend on the entire planet. And this is the exact conflict that has the market totally split.
So, before we get into the bull and bear arguments, let's pop the hood and do a quick check on the company's financial health.
All right, so revenue is up a healthy 5% over last year. That's solid. Operating cash flow, which, is the real lifeblood of a business, is super strong and growing at 8%. But wait a minute, look at net income. It's down 6%. That tells you that even while they're selling more, their costs are going up and their margins are getting squeezed, probably because of those supply chain problems we just talked about. And you can see they're returning a ton of money to shareholders, over $2.5 billion in buybacks in just this one quarter.
Okay, with all that in mind, let's build the bull case. Because the argument for Qualcomm is that, yeah, the smartphone business is tricky, but the future is all about these new growth areas.
And this slide just lays it all out perfectly. Just forget about phones for a second and look at these numbers. The automotive business grew an incredible 36% last year. The Internet of Things segment up 22%. They're aiming for a combined $22 billion in revenue from just these two businesses by 2029. This is their big escape plan from the volatile smartphone market.
And just to show you this isn't some fantasy, their design win pipeline for automotive, that's deals they've already locked in, is worth over $45 billion. It's like a restaurant having confirmed paid-for reservations for the next 5 years. A huge chunk of that future revenue is pretty much guaranteed. So to wrap it up, the bull case is this. 1, they're the leader in on-device AI, which is going to be a huge deal for the next wave of phones and PCs. 2, their automotive and IoT businesses are absolute growth machines. 3, they generate a mountain of cash, which lets them fund innovation and reward investors. And hey, 4, there's even a long shot that they could use their chip know-how to jump into the data center game themselves.
But that's only half the story. Now we have to flip the coin and look at the bear case, because the risks here are absolutely massive, and they really come as a pair.
The first huge headwind is China. I mean, look at this. Almost half of all their revenue comes from China. This makes them incredibly vulnerable. Any little flare-up in geopolitical tensions, trade wars, new regulations from Beijing, and Qualcomm is stuck right in the middle of it.
The second headwind might be even scarier: Apple. We all know Apple is desperately trying to build its own 5G modems so they can kick Qualcomm out of the iPhone. Well, that transition is coming,
and analysts think it could blow an $8 billion hole in Qualcomm's annual revenue. That is a gigantic hole to fill, even with all that great automotive growth.
And it's not just those two big issues. They're getting attacked from every direction. You've got MediaTek eating away at their market share in mid-range phones. You've got giants like Samsung and Google also making their own chips now. And to top it all off, the king of AI, NVIDIA, is starting to move into their new promising markets like automotive. It is a multi-front war. So, you've got this really compelling bull case on one side and a genuinely terrifying bear case on the other. It's really no surprise that Wall Street has absolutely no idea what to do with this stock right now. Just look at the 52-week range for the stock. It swung from around $121 all the way up to over $205. That's a huge range, and it just screams uncertainty. You've got firms like Piper Sandler saying it's worth $200, but then you've got Bank of America rating it as an underperform. The experts can't agree, which just perfectly reflects that bull versus bear tug-of-war we've been talking about. So look, I'm not here to tell you to buy or sell. What I can do is give you a checklist. These are the specific things you need to watch that will tell you which side of this argument is starting to win.
Number 1, watch that automotive growth rate like a hawk. Is it speeding up? Can it realistically grow fast enough to fill that massive hole Apple is about to leave? Number 2, keep an eye on the PC market. If their Windows on Snapdragon chips actually start stealing serious market share from Intel, that's a huge win for the bulls. 3, any news about the exact timing of Apple's modem switch is critical. And finally, number 4, always have one eye on US-China relations. Any new tariffs or regulations could slam this stock overnight.
When you strip everything else away, it all comes down to this one simple question. Qualcomm is in a race against time. It has built these powerful new growth engines in cars and IoT, but at the same time it's being chased down by its old problems, its massive dependency on China, and the looming departure of its biggest customer. Whether those new engines can outrun the old problems, well, that's going to determine everything.